to the weekly Saturday knowledge sharing webinar organized by Mehta and Mehta. And today's topic is intercorporate insight into loan to the directors and intercorporate loans and investment. Our presenter is Ms. Alifia Sapatwala, partner Mehta and Mehta. Alifia is an associate member of ICSI and also commerce and law graduate from Mumbai University. She possesses around 10 years of experience in corporate secretarial and legal matters. She specializes in listing, FEMA, and NBFC compliance and has been handling compliance under various corporate law for both listed and unlisted companies. Welcome and thank you, Alifia. We have with us today's our panelist, Ms. Anshu Agarwal. And Anshu, welcome Anshu. She is coming, I think, second or third time. Thanks for your time, dear. Anshu Agarwal is a BCom and law graduate and is a fellow member of ICSI. She has over 18 years of experience in the field of corporate law, merger, acquisition, fundraising activities. Prior to joining Borosil, she has worked with the business group like Reliance Industries, Reliance Infrastructure Limited, IFL, and Loda Group. Presently, she is working as a group company secretary for Borosil Group. Welcome, Anshu. Thanks for your time.
Yes.
And your experience will really helpful to our participants. Friends, as usual, we have our Mr. Bala and Mr. Sudhakar. Sudhakar is again back to India. So now he can little bit extend also his presence. Of course, he has never said no, but we were only concerned. So as usual, I'll request friends, this topic of loan to directors, intercorporate loan and investment. Of course, all topic of Companies Act is important. Even the last chapters of penalty prosecution is most important, which we avoid of reading, but that is most important when it is required. So loans to directors, loans and investments, intercorporate loans. It's always a very crucial topic when the company deal with the finance. And this is going require a lot of interpretation. And I'm sure today's panelists will discuss in depth and all participants get all queries solved. I'll request Anshu to say a few words on the topic, then Sudhakar, then Bala, and then Alifia, you can start the presentation. Over to Anshu.
So, hello everyone. So the today's topic 185 and 186 basically loan to directors and intercompany loans, guarantee investments. So everybody these sections are applicable to each company, be it private, public, listed, unlisted. Each company it is applicable and very important, little complicated. But if we do the careful analysis and dissect the section, it's not that difficult. It looks difficult, and 186 is more. So it's, as we know, that it is non-compoundable. So we really need to be hands-on and be fully aware of the provisions. So I will not take much time at this moment and will hand over the session to the presenter, followed by Sudhakar sir's words. So look forward to having great interaction with you all.
Thank you. Yes,
Sudhakar, please. Sudhakar, please.
Yeah. Good morning, everyone. And best wishes on the Navaratras. In fact, today's webinar is, according to me, a very significant one because the two important sections, 185 and sections of 195, 372A. And prior to that, it was 370 and 372. In fact, whenever there used to be any kind of inspection by an ROC, these are the sections always under the radar of the Register of Companies. These sections, though they are not new as such to the company secretaries, but almost for the last 35, 40 years, I am reading it, but it still looks new. Whenever we have to implement the sections, we have to refer to the book. Very complicated sections. And Another important thing is that most of the times the company secretaries have pressure from the management or from the promoters or from the CFOs to give loan to the group companies, especially when you are working for a group. The pressure on the company secretary will be tremendous because always the transfer of funds is important within the group companies, and you are going to trigger provisions of Section 186. So it is very important for the company secretary to be thorough with the provisions of Section 186. The same point of time, they have to also sensitize the repercussions of non-compliances. Because Section 185, though it is compoundable offense, but if you see the penal provisions, the penalty, the fine goes right from 5 lakh rupees, it can be extended up to 25 lakh rupees. Whereas in case of Section 186, it is a non-compoundable offense. So one should be very careful. Any officer who is contravening these provisions, he will be definitely subject to penal provisions, and that penalty is going to be non-compoundable. Under the erstwhile 372A, that time also it was non-compoundable, but there was a carve-out was given at that point of time that in case the loans were given without complying with the provisions of 372A, and before ROC institute the adjudication proceedings, then that imprisonment was not there. Such kind of carve-out is not there in the Companies Act 2013. So one should be very careful. So my humble submission and advice to all the company secretaries who are participating in this webinar, I mean any professional. So please sensitize your CFO and your CEOs and all others, and the interfunding transactions or inter deposit transactions within the group. Whenever you are giving the loans, guarantees, or securities, you have to be very careful. Have sufficient what's called as these board sanctions well in time. At the same point of time, as far as 195 is concerned, same thing that any kind of loan to any director, it is to be dealt with very carefully. How it is to be done and all, we will discuss while the presentation is going. I used to say always that these are the three sections which are very important. The one is 185, 186, and 188. The most complicated sections, the most significant sections, and the darling of the regulators whenever they come for inspection or investigations. And it's coincidentally, it so happened that all these three sections are applicable to private companies also, of course, subject to certain kind of roads have been given there also. So whether you are a company secretary of a private company or a public company, I give a pause here and over a period of time we will discuss it further. Bala, you may kindly take over. Thanks.
Good morning to all of you. The earlier two panelists very clearly spelled out, says the section seems to be simple, but it is more complicated. And Sudhakar touched upon whenever you talk about the group companies and the urgency and the stress, etc. But if I look at the sections, it appears to be very simple. If I see 185, it is simply deals primarily subject to the person to whom the loan cannot be given. Very clearly, it says that. So that way we see these are the people cannot be given, we take it for granted it can be given. But that is not the end of all. Then again, if we come to the section 186, that talks about various exemptions which are available and also the limits up to which the loans can be also given. Now, what happens with nitty-gritties involved is, as he rightly said, it is applicable to every company, public company to public company, public company to private company, and again, parent company to subsidiary company, whether it can be vice versa, what happened to the common directors, all these nitty-gritties are involved. In fact, I appreciate Sudhakar's view very much. The company secretary had the tremendous pressure. People wanted to take a meeting in the morning, in the afternoon, they want money to be disbursed. That sort of the pressure which used to be there, especially with the group company, because they are ready with the money. You give me the approval, we will disburse the money. That sort of a thing which is working without understanding many issues which are happening and the complications. These two sections are very, very important sections. And again, here what happens is people think that we can take a blanket approval. which is not permitted at all. Because if the specified limits are exceeded, you have to go to the shareholders. Again, it is a prior approval is actually required to be done. Various things are there. I think we go through so that the two panelists we have that they will share their practical experience and other things and all. As usual, I request the participants to put up their queries and questions in the chat box. We will take periodically as and when the thing presentation goes on. And at the end of the session, people can raise their hand that they can also speak out. And at this particular moment, I could see almost around 250 people are actually present. That is shows the importance of this particular topic, especially at the time of the festive Navratri season. I am overwhelmed to see this participant in the beginning of the session itself. Over to Alifia, please.
Before Alifia takes, I want to also say one more thing that SSB has come with a guidance note, and ICSI has released that guidance note on section 185 and 186 yesterday. That's what I have been told. So very soon it is going to be in our hands. And since I was a part and parcel of the SSB while drafting this particular guidance note, I'm privy to certain what's called as an the interpretations and other issues related. So which I will be discussing it while Alifia is making her presentation. Thank you.
Great news, Sudhakar. Definitely, I'll be interested in going through it as soon when it is available. Thanks a lot.
Thank you.
Good morning,
Alifia.
everyone. Hope I'm audible
Alifia,
now.
your presentation is not visible. Because you open the file, I can see the file list only on the screen, not the presentation.
Yeah, presentation is not visible. Just open it.
Yeah, now it is open. You can put it in the presentation mode.
Yeah. Yeah.
Hope now it is visible
Yeah,
to everyone.
yeah, now it is very much visible.
Yeah.
Okay. So, good morning, panelists and my dear professional colleagues. I'm Alifia Sapatwala, and I'm here to present you an insight into loans to directors and intercorporate borrowing. So, regarding the Companies Act, there are stringent governance standards regarding the financial dealings of a company, and its responsibility has been cast on the directors to regularize everything. So section 184 to 187 are very critical, as already pointed out by the panelists, and the directors have to ensure that they act in the best interest of the company. They should also ensure that there is a transparency and accountability of all the financial transactions which a company is entering into. Further, these provisions also govern the disclosures of interest. They regulate the loans and guarantees, and also mandate that proper documentation is available so that the shareholders get an oversight of the financial dealings the company is entering in. Section 192 and 193 of the Companies Act also strengthen the corporate governance by ensuring transparency of transactions involving directors and members of the one-person companies, whereas Section 192 restricts companies from entering into non-cash transactions. So, we begin our presentation by giving a brief account of the disclosures which every director has to make of the interest which he has in other companies. This is very crucial so that the company is aware in which companies or firms the director or his relatives have an interest. A director has to disclose his interest in any company, firm, or association at the first board meeting after they are appointed. Also, in the first meeting of every financial year, or when there is a change in his interest, the director has to disclose in the next board meeting. The directors also have to disclose their interest in any contract or arrangement with the body corporate where they hold more than 2% or they serve as a promoter, CEO, or manager, a firm or entity where they are the partner, owner, or members. Such directors also cannot participate in the board discussions related to these contracts. Further, the provisions also provide that if a contract is entered into without the director giving the required disclosure or participation from an interested director is there, it can be voided by the company. The directors violating these provisions of disclosures are liable for a penalty of rupees 1 lakh. However, there is an exemption to contracts where directors hold less than 2% of the paid up share capital of the company or a body corporate. Rule 9 of the company's meetings of board and its power rules provides that every director must disclose any concern or interest in company's forms or association by written notice in Form MBP1. This is very crucial as it provides a proper format in which the disclosures are made available to the company, and any contract which the company may enter into in future, they are aware of the interest of the director. Further, the director must also ensure that his disclosure is made in the first board meeting held after giving the notice. The notices must be kept at the registered office of the company and preserved for a period of 8 years from the end of the financial year it relates to. And this notices must be held in the custody of the company secretary or a person authorized by the board. All these provisions are to ensure that there is no contract entered into by the company which is void. So now we begin with section 185, which relates to loans to directors and related parties. It provides that no company can directly or indirectly advance loans or provide guarantees or securities for loans to any director of the company or its holding company, any partner or relative of such a director, any firm where such director or relative is a partner. Companies Act already provides a definition of relative under section 277 of the Act, which provides that husband, wife, father, mother, brother, sister, son, son's wife, daughter, daughter's husband are all considered related. The exceptions to this section are loans and guarantees can be provided if the special resolution is passed in the general meeting. The notice giving full particulars of the loans and its usage is given, and the loan is utilized for the principal business activities of the borrowing entity.
Sudhakar, would you like to say the principal activities of the business here? Your views?
See that, in fact, the principal activities of the borrowing entity, that means, when a company is incorporated, the object is definitely given in the memorandum. That is in the main objects for which the company was incorporated, and whatever from time to time, whenever the company wants to take up some other activity, it has to amend its objects clause. So whenever, suppose, say, for example, it might be a manufacturing company. So whenever you are borrowing the money, if it is a manufacturing company, you have to use
Some disturbance in your voice.
Yeah. So what I'm trying to say, Bala, is that whenever you borrow the funds, that funds are to be utilized for the main objects of the company. If you are in the business of a manufacturing, then obviously the funds, whatever you have borrowed, you have to utilize for the purpose of that manufacturing activity only. It should not happen that you are borrowing the funds and you are lending that purpose of principal business activities of the company. That is how it is to be established. Okay. Yes, Alifia, go ahead.
Yes. So here we begin with the term of explanation of the term person in whom the director is interested. So this term includes private companies where the director is a member or a director, any body corporate controlled by such directors, and entities accustomed to act under the direction of such directors. So this is again very important term which defines which firm or companies are required to be considered as the person in whom the director is interested. Further, this restriction does not apply to loans given to a managing director or a WTD as per the terms of their appointment. Companies providing loans in the ordinary course of business and they are charging an appropriate interest. Loans from a holding company to its wholly owned subsidiary, and guarantees or securities provided by a holding company for loans taken by its subsidiary from banks or financial institutions.
So in case of loans to the managing director and the whole-time director is available to all the employees. In the erstwhile section 295, there used to be a provision that if the managing director or the whole-time director, whenever they were appointed, in their employment contract, if there is a provision to lend money to them, that was exempted, which is not the case in case of 185. In 185, there should be a loan policy of the company and the loan should be available to all the employees. So you cannot, by exception, give loan to the managing director or the whole-time director, number one. Number two, if there is a loan policy, that loan policy, whatever is applicable to other employees, the same is applicable to the managing director, whole-time director also. In fact, yesterday only we were examining one case wherein it was the loan policy is there and it says that X amount, I mean, all the employees are eligible for the availing the loans up to 3 months of the salary, subject to a maximum of X amount. However, in the same loan policy, it was also mentioned that in case any kind of loan is to be sanctioned to any employee over and above the limits, the board has a power to review that and sanction that loans. So only in such cases that loan to the managing director or the whole-time director, if you are giving exceeding the limits, the board can review that. Otherwise, whatever is there as per the loan policy, only it is to be given to the executive directors also. As far as the other directors are concerned, they may be non-executive directors, they may be independent directors. Absolutely no question of giving any kind of loans to them.
You're touched upon the very right point, Sudhagar, because what happens is in case of the managing director and the whole-time director, they are also as good as the whole-time employment of the company. So when the scheme is formulated for the employees of the company to take care of the things in the group, then automatically there is no separate treatment for them by virtue of that particular thing. That's what you touched upon. That is there. Because we used to get the confusion earlier by looking at the section. But ultimately, what you said is absolutely correct. Anshu, you would like to add something, your views?
Yeah, sir. I would like to add here. So just be mindful that what is exempted is only the loan to managing director or whole-time director. Let's take an example. Your managing director is taking a loan from HDFC Home Finance, example. And HDFC Home Finance is wanting a guarantee from your company कि आपका एमडी लोन ले रहा है हमसे, आपकी कंपनी गारंटी दे दो फॉर दिस लोन. That is not exempted. So what is exempted is only and only loan to MD, giving of guarantee or security for the loan being taken by MD or WTD is not exempted. Just be mindful of that. Point number one. Point number two, what we see here is MD and whole-time director. So a question may arise, what about manager? The manager under the Companies Act. Can the loan be given to manager or not? So any views here? Otherwise I will just give my view. Okay, so let me give my view. The section applies to loan to directors. So manager is not a director. If he was a director also, then he would basically be an MD. So if when a manager is just a manager without being on the director on the board, then he's just an employee of the company, just like any other employee. And then the section does not govern the loan to manager per se. So these are my points here on this particular point. As we move along, I'll add to it.
Points important, sure.
Regarding the second point, also it is important to note that companies providing loans in ordinary course of business. So people always think NBFCs are in the business, but it is usually have to be checked whether the NBFC is in the business of lending. It may be in the business of investing only. So that again is not exempted. So that is also important, and charging an appropriate rate of interest. So it has to be as per the prevailing rate of interest, which is applicable to all the loans. You cannot have you are charging a 2% of interest and that would suffice. It has to be as the prevailing rate of it.
if I may just add here, this I have seen few company secretaries taking a view that giving of the loan, who are not NBFCs or home finance company, just giving that if my company is having surplus money, surplus funds, and it is part of my ordinary course of business, I think that view will not sustain, and we should avoid getting into that practice.
Yeah, it should be, see, it should be whenever an NBFC company is registered with RBI, it is always indicated the activities of the company. If it is only in the lending activity, then only it is in the ordinary course of business. If it is investment, lending, guarantee, securities and all, then it is not falling into this particular exemption. Okay. So it should be a core lending company.
Yeah.
Further, it is also important in the third point, loans from holding company to its wholly owned subsidiary is exempted, but not to a subsidiary. So for a subsidiary, a company can only provide a guarantee or a security for the purpose.
If I may add here.
Yeah, sure. Go ahead.
So, as Alifia said, that wholly owned subsidiary loan is exempted, and if it is non-WS, then only guarantee and security is exempted. So, if you see in the exemption is loan from holding company to wholly. Suppose I have a subsidiary which is non-WS, it's just a subsidiary. Can I give loan to my subsidiary? The question may arise, what is exempted is only loan to wholly owned subsidiary, but if I want to give a loan to my subsidiary which is non-WS, can company give loan? So my view here is, what is exempted, so it's not prohibited. If my subsidiary is a subsidiary, whether as we know that Olivia said, 185 is divided into prohibited, regulated entities, and exempted. Prohibited, we know that directors, relatives, partners. There are regulated entities. So regulated entities, you have to see whether your subsidiary, which is recipient, falls into regulated entities. That is, it is a private company in which director is a director or member. It is a body corporate in which directors are holding 25% power, or that subsidiary in which directors are accustomed to act. So if it is falling into that, subsidiary is falling into that bucket, then you have to comply with that, and then can give loan to subsidiary. So you have to examine that subsidiary falls into that regulated entity or not. If it is not falling into that three kind of private company or body corporate, etc., then it is not governed by 185 and you can give loan. Yeah.
I don't know whether Alifia you have covered that or not. Anshu has mentioned that accustomed to act 185 1C, I think, if I am not wrong, that subsection. I don't remember that. It is accustomed to act. Also, it comes under the directors where they're interested. It is a regulated entity and you need to pass the special resolution. So one need to understand what is the term accustomed to act. Accustomed to act by whom? Is it by the holding company or is it by the promoter? So like that, when this section 185 came into picture in the year April 2014, there were several banks, they stopped lending money to the companies, especially the subsidiary companies, stating that these are all the companies accustomed to act and they have to comply with section 185. The question comes, by merely a company is a wholly owned subsidiary, can you say that the company is accustomed to act as per the instructions of the holding company? That was an issue. So it is a rebuttable issue, and you can always establish that though it is a wholly owned subsidiary company, but it is having its own separate board. Those board of directors are having their own accountabilities, responsibilities, and obligations towards the company. Whatever the instructions given by the parent company, that is holding company, you may take it into view before you are deciding that matter, but you are not going to decide that without application of mind. Custom to act is to a large extent, it comes that the person who is receiving instructions is implementing those instructions without application of mind, which is not the case here. At the same point of time, sometimes it may so happen you are receiving the instructions. By merely receiving the instructions, you cannot say you are accustomed to act. You have to on those instructions. At the same point of time, sometimes it may so happen, it is a one-off transaction. Always a holding company ensures that this wholly owned subsidiary company's activities are properly monitored by the holding company board because it is an obligation. Its own funds are there. It is like my son. As a parent, I have to take care of my son. I have to regulate him. Same is the case with the holding company also. But that doesn't mean the wholly owned subsidiary company is implementing those things without application of mind. So always, in fact, okay, when I was working with Reliance, this issue has come up, and we could successfully establish that our wholly owned subsidiary companies are not accustomed to act as per the instructions of the holding companies. That is one part. Second thing is, please remember that section 185 has used both 185 and 186 have used the words directly or indirectly. So, as a company secretary, please ensure that sometimes it may so happen that transactions are not taking place directly, but the transactions might be taking place indirectly. What is an indirect way of giving loan? We all know that the transactions which you are engineering so that they are not coming out directly so that you can circumvent the provisions of the Act. As I told initially itself, that these two sections are very significant sections, and ROC is going to scrutinize these transactions more than any other sections. That's why, as a company secretary, you have to be alert that no transactions indirectly are also happening at that. The third point is that if you see in the 185, it says that loans are prohibited, not only the loans, but loans by way of book debts also. So, what is meant by book debt? So, you have to understand the difference between a loan and the difference between, I mean, loan as well as the book debt. Loan is entirely different, because that if you have to consider a transaction as a loan transaction, then what happens is that there should be two parties. One party is lending, another party is borrowing. There should be an agreement. There should be a terms and conditions, etc. are there. And to a large extent, book debt means for supply of certain products, for supply of certain services, there is a commercial transaction is there, wherein that one party has to make a transaction, but by providing goods or services or whatever it may be. So there is a difference between loan transaction and a book debt transaction. But what 185 says is that any kind of book debt, if it turns into the nature of a loan, then it is covered under 185. Where it comes, how you will how you will demarcate a book debt as a loan. Suppose, for example, you are giving credit period. Say, for example, you are giving normally it is the 30 days credit, whereas you are giving to your director, say, for example, a 300 days credit. Means what? You are actually you are facilitating a transaction in the shape of a book debt, but it is virtually a loan. The same point of time, it may so also happen you have extended a book debt and you are not bothering to recover that money. Means what? You know the transaction. You want to give a kind of a loan and you have extended the credit facility, not bothering to recover that money over a longer period of time. So there will be a number of examples you can give it. So as a company secretary or as a secretarial auditor, you have to be very alert and see these kind of transactions are there or not there. Fortunately, if I am not wrong, in Caro, the auditors also have to comment about this 185 or 196. Of course, now the compliances of overall Companies Act also they have to comment about. So secretarial auditor cannot just rely upon the statutory auditor only. He too have to be vigilant about these kind of transactions. One more thing comes that the loans to a managing director or executive director, I have mentioned that as per the loan policy. Sometimes it may so happen that a company has provided a corporate credit card to the managing director or to the whole-time director. I mean, let us call them as executive directors. They have incurred certain personal expenditure on account of that credit card. Say, for example, a managing director has traveled abroad with his family on a holiday. and he has used the corporate card because the limit that is unlimited card, whereas his other credit cards might be having a limit. Now, is it a loan? Answer is not so, because sometimes it may so happen. Or you say that suppose he is going on a business trip and he has incurred some personal expenses. So what happens is you cannot give an yes or no answer here. You have to see that the moment the credit card statement comes, or even before that, if the managing director is reimbursing his personal expenses to the company, before it makes the payment to the bank concerned on which it has taken the credit card, then absolutely there is no issue. But suppose if the company has made that payments to the bank concerned and it is not recovering from the manager, the executive directors, that point of time it will trigger section 185 because it will be considered as a loan extended. Another point is that under the Companies Act 1956, there was a section 296 which says that the book debt from the inception shall be in the nature of the loan. That means whenever the transaction was entered into, that point of time itself, that book debt it should be in the nature of a loan. That carve out is not there under section 185 of the Companies Act. So that means what? During the course of the transaction, at any point of time, the book debt may turn into a loan transaction, which was not the case under the Companies Act 1956. So here also one should be very careful that at any point of time, if that book debt transforms into a nature of a loan, then you have to ensure the compliances of section 185. Now the question comes, from which date the compliances have to be ensured? It is the date on which that book debt is getting into a loan transaction. That is the day which triggers, not from the day one. Day one, it might be a book debt. Up to, say, for example, date 125th, it might be a book debt only. But thereafter, it is turning into a transaction of a loan. Then you have to ensure the compliances. And these are certain final points I thought I will bring it as far as section 185 is concerned. Of course, whenever there is any participants issues are there, we will discuss further. Yeah.
Sudhakar, you are very nicely touched upon these two sections actually. There is a tremendous amount of application of the mind which will be required for the company secretaries who are working in a parent, subsidiary, subsidiary to subsidiary, group companies, associate companies. To my experience, I spent almost about 20 years with the listed company. I never had a problem on these sections. But the moment I switched over to the private limited companies, the group companies, which are having almost about 18 companies under the same group, we had a lot of things. I have a lot of learning on this, whatever you said just now, especially with the reference to the common director, especially private to public, public to private. So many things which there. It is really a tremendous application of the mind. And not only that, it is very vigilant. In the beginning, as you touched upon very clearly, it gives a very, very tremendous stress and tension and pressure. One has to be very, very careful in application. We should not end up in the non-compliances.
So what here, Bala, what I'm trying to say here is only that sometimes the company secretaries may ask the question that हमारा कोई सुनता नहीं है, and this is a normal this thing. Several times in the conferences also people used to say, sir, you are working for a big company, they will ensure, but smaller companies, unlisted companies, private companies, they don't listen to us. See, sometimes it may so happen they may not listen to you. That's why I always suggest that the way, Bala, you are writing the articles day in, day out, the ROC left, right, center educating the companies wherever the kind of non-compliances are taking place and imposing severe penal provisions. Whatever the maximum is there, he is triggering that maximum, suppose penalty or fine. What as a company secretary you can do is please circulate a bulletin of the latest whatever is happening in the corporate circles to your CFO, to your directors and all, whether they ask it for it or not. One time or the other, they may just glance through that and then they will come to know what is the seriousness of the the seriousness of the compliances are concerned. And especially these two sections don't take any kind of a chance. And you have to have, your secretarial department has to have good relationship with the accounts and finance departments so that these kind of what's called as okay, the book debts and then the loans and all these things can be avoided. Yeah.
Sir, to all the humbleness to our fraternity, what is really required is you touch upon the right point. हमारा कोई सुनता नहीं है. We need to have the courage of conviction, which many a time we are actually lacking. That we have to develop because we take it for granted. Oh, how can I talk to them? They are such a high people. What is happen? What will happen? They will say all this sort of the fear is actually there. We don't have the enough courage to put up the thing. That probably people have to visualize themselves. They have to come forward. I'm sure. What is your experience? Because you have been a company secretary. Normally, we feel, many companies, they always say, we prefer to employ only the male company secretary. You have been
Yes, sir.
successfully for the last 2 decades. Your views on this, please.
Yeah, it's very rightly put up by Sudhakar sir that we face, generally the CFOs and the head of the accounts don't consider our department or our function, that they say like, especially if it is a female, that how can you say कि ये नहीं कर सकते हैं, or especially your predecessor has not been raising these points, then suddenly you come and say. So these are the challenges in our profession, but I think we have to learn to put it across strongly, and put it on the email that this cannot be done. Don't be afraid that how can I send it in email when he has sent it. No, I use generally a trick. First I put it in email and then go to discuss, so that I already put it on mail.
Not only that, you see that several times it may so happen. Suppose if they receive a fat ROC notice imposing the penalty, then they will again blame the company secretary. Why didn't you tell me in the beginning itself? And he will say, okay, sir, I tried to inform you. Well, what is meant by trying here? You should have put your foot down. Why you have not done that? Number one. Number two, whenever you have to, because you are meant for this thing only. Don't think the profession of a company secretary is a bed of roses. You have to undergo the struggle. People may not listen to you, but you have to make them to listen to you. That's why I always say that, that you need to sensitize your management, your CFO, other department, because the way the Companies Act 2013 provisions are there, in isolation, a company secretary cannot comply with. In fact, wherever I do the corporate training, I always raise this issue, tell the managements and CFOs very clearly post-retirement. In fact, whenever I am doing any kind of corporate training programs, any kind of IOD programs, or anywhere I speak, I always say that the days are gone where the company secretary is only responsible for the compliances. Whether you take Companies Act or whether you take listing regulations. Everywhere that entire management, whoever are the senior people are there. Say, for example, related party transactions. It is not only the CFO or the CS or the CEO who are responsible. Even the other people, by who are entering into the contracts with the other parties, they're all responsible. So you have to sensitize your salespersons, your materials persons, your HR, and all the people, whoever is dealing with the related parties, you have to sensitize them. Same is the case with case of 150, 185 and 186 also. Yeah. Yes,
Yes, Alifia, go ahead.
Yes. So subsection 4 of section 185 provides for the penalties for any contravention that may happen. So the fine for a company is between 5 lakhs to 25 lakhs, and for the officers in default is imprisonment up to 6 months and or fine between 5 lakhs to 25 lakhs. If the recipient is the director or other person, then the imprisonment is up to 6 months and or fine between 5 lakhs to 25 lakhs. So again, the penalties imposed under this section proves that compliance with section 185 is very, very important, and any non-compliance is seriously viewed.
So God forbids, if any issue comes, the ROC is going to impose 5 lakhs minimum penalty. Okay. And whether he can impose more than that and all, it is up to his discretion. But 5 lakh to lagega company ko and every director and every the KMP ko.
Many ROCs tend to put the maximum penalties, Sudhakar.
Yeah, that's huge amount.
Yeah. Because minimum is there, as you touch upon very lightly, but the thing is, I have seen the way adjudication orders are passed, they always put the maximum penalty to the greater extent. There are very few ROCs, they actually go by the limit wherever it is given.
And Bala, I also take this opportunity to submit and advise all the participants is please do read the articles of Professor Balakrishnan on these, especially he is writing, I think, per day one article kind of thing. If you see that, if not anything else, you will come to know the mindset of the ROC. That is equally very, very important for us. In the good olden days, what happens is, obviously, whenever you take an action, say for example, sometimes you may not be able to comply with the section. Then you always see the downside risk. Now, the downside risk, to understand that, you need to understand the mentality of the regulator, mindset of the regulators. And these days, the private company or public company, they are not bothering. It is a company, penalize it for non-compliances. So that is very important. So please do read these articles also. I'm not just promoting Balakrishnan here, but what I'm saying is that by at least I'm getting immensely benefited, and I'm sure you all will get benefited with his articles. Yeah, Lifia.
So I just want to raise 2 points here on 185. Loan to LLP. What is covered under the section, as we just recall. Uh, Point number 1, prohibited category says partnerships firms where the directors or relatives are partners. The regulated category talks about private companies or body corporate, and the exempted category talks about WOS or directors or subsidiary. So LLP, partnership firm is prohibited. What about LLP? Sometimes we say that LLP is a body corporate, but if you apply the provision of body corporate, the 3 provisions which are regulated, that is private company or private company in directors, which will not apply. A body corporate in directors are holding 25% voting power and accustomed to act directors, etc. All those will not apply. So whether a company can give loan to LLP in which the directors of this company are partners and etc. Whether we can do that, because per se it is not in black and white covered under 185, the loan to LLP. So my view, and then I'll request Sudhakar sir or Mr. Balasa to share their views. My view here is that for the purpose of this section, we must treat LLP as a partnership firm. And if the directors or their relatives are partners in this LLP, we must prohibit from giving loan to this LLP. Otherwise, we would be abusing the section, is my view, and would request others to share their view.
I agree with you, Anshu. I agree with you.
100% I'm in confirmation with your views. 100%.
Okay. One more point which I could see on the chats relating to 185, the participants have asked is that whether a subsidiary can give loan to its holding company, right? So there is no restriction per se. There is no restriction. Although exemption is from holding to subsidiary and wholly on subsidiary, etc. The section doesn't talk about subsidiary to holding company, but it's not prohibited. If the 185(2), the categories of private company and body corporate, etc. If you have to check the holding company is falling into that bucket or not. If yes, it is falling, then you can do it subject to the compliance of what is required, special resolution and so on. If it is not falling into that bucket, then it can be done. There is no restriction per se.
I agree with you. In fact, in one of the group company where I was associated with the Vodafone group company, one of the subsidiary company was having a surplus amount of money which we wanted to give the loan. After complying with the things, we have done it. So there is no restrictions in the section as such. It can be vice versa also. Yeah.
Yeah.
So
I think
I would like to ask here, okay, if the subsidiary is giving a loan to a holding company, and if nothing is being prohibited under that, would Section 186 become applicable intercorporate loans and borrowings here?
Of course, yes.
Accordingly,
185 and 185 have to be complied together. They are not in
yes.
substitute that 185 is complied, then we can
So,
ignore 186. Both the provisions have to be complied simultaneously.
Yeah, that is right. 185, 186
there is an
goes
interplay of provisions, and accordingly the limits and everything which is
And we know
provided
that under
under
186 now any person is also included. So a person is like director is also a person. It has to be complied.
both the section goes hand by hand. Yeah.
Only both the sections, even section 179 also comes into picture whenever there is a kind of lending activity or investment activity. So you have to see that compliances also.
So now I think we can
So
move to
here,
186. Okay,
Yeah.
Alifia. Sorry, you can
so
continue.
Yes,
yeah,
Olivia.
so there is a case law here of Hewlett Packard Enterprise India Private Limited versus Registrar of Companies Bangalore, which involves violation of Section 185 of the Companies Act regarding loans advanced to directors or entities in which the directors were holding an interest. So, HP India extended a loan of rupees 360 crores to its subsidiary, and this transaction was questioned under Section 185 as both companies had directors common at that time. So it was contended that the loan was advanced in the ordinary course of business and with no malicious intent, claiming that the funds were repaid again. However, the company filed for voluntary compounding when they realized that it will be a non-compliance of Section 185. The NCLT recognized it to be a non-compliance and accordingly imposed a fine of rupees 10 lakh on HP India and an additional 5 lakh on its managing director. And when they went to NCLAT, the decision for this was upheld and confirming the fines for this non-compliance. We also have another case of Neelam Dhawan versus Registrar of Companies, where Neelam Dhawan, directors of a company, faced prosecution for violation of Section 185. This section prohibits companies from advancing loans to directors without prior approval from the shareholders. The loan was extended by H to its subsidiary, which shared common director. This transaction was happened before the amendments to Section 185 came into effect. So the appellants argued that under the pre-amended provisions only, the company and not its directors were liable for breach. However, it was held by the ROC that the amended provisions could not be retrospectively applied to hold the directors personally liable for the actions taken prior, and CLED deliberated on the matter whether the directors could be prosecuted for these actions and if the ROC acted within its power by initiating prosecution. Ultimately, important questions were raised in this case regarding the retrospective application of corporate governance laws and the extent of director liability under the Companies Act.
So, Alifia, before you go to 186, now there is one more thing that Section 185 is not applicable to private companies. There was a circular of 5th June, I think 2014, if I am not wrong. And that says actually there are three conditions if they are comply with. Then Section 185 is not applicable to private limited companies. That there is okay. So, and subsequent to that, the Section 185 has been rehashed by the Companies Amendment Act 2017, which came into force from 2018. So there were a few times issue has come up is whether this circular is still valid post rehashment of Section 185 or the circular is over in existence. The answer to that is that Section 185 provisions might have been changed, but the circular has not been withdrawn. And the present existing provisions of Section 185 also is more or less on the same lines of the old Section 185. So the circular is still valid for all purposes and whatever it is there. This issue has been clarified in the guidance note also. Okay. This was my view right from the beginning. And the same for the benefit of all the professionals, we have clarified this in the guidance note.
Great, Sudhakar. Great.
So
Yeah,
now we
Apriya.
come upon to Section 186, which pertains to loans and investments by companies. So
Should
here
we
it
take up
provides
the questions what are put up in the meantime for 185?
Oh, yes.
Yeah, we'll do that. Can a holding company gives the interest-free loan to the wholly owned subsidiary company?
That is under covered the 186 Pala. I think we have to discuss 186, then only we can do that.
Okay. The next question is actually 186, so we will not take that question here. Can a subsidiary give loan to the holding company? That I think we discussed now. Any guarantee security provided MD W20 for his exemption can avail. That also you discuss actually when you are talking specifically. Does company investment in mutual funds attract? I think that is 186. We'll take it later. Can a subsidiary 100% or
See, for you,
under,
I think, Bala, for you, it is very difficult 185 and 196 to segregate it. So,
yeah.
what we will do is when
Hmm.
let 186 started,
Hmm.
and in between, we will stop somewhere and then address all these issues.
Okay, sure.
Yeah.
Yeah. Yes, go ahead, Aflia.
So 186 provides that companies cannot invest through more than two layers of investment companies. And there are exceptions to this where foreign companies with more than two layers of subsidiaries under foreign law is allowed. And subsidiaries with investment companies required for legal compliance are also exempted. So the investment companies have been specifically defined under Section 186. Section 186 also provides for the limits up to which the loans, guarantees, and investments can be made by a company. So a company shall not give loans, provide guarantees, or acquire any securities which may extend beyond 60% of its paid-up capital, free reserves, and securities premium, or 100% of free reserves and securities premium, whichever is higher. So these limits are important to be reckoned with. Before making any investments, loans, or guarantees, the company has to see to it that proper limits are reckoned and the investment does not fall beyond these limits. However, if any loan or investment is made beyond this limit, a special resolution will be required by the company where the approval of the members is sought to approve such limits. So the exceptions are loans being given to wholly owned subsidiaries in joint ventures, and loans or guarantees for wholly owned subsidiaries also do not require special resolution, but the same has to be disclosed in the financial statements. Sudhakar sir, you may throw light on the limits pertaining to wholly owned subsidiaries.
Now, what is that? I couldn't, just I was for a minute, I was, what is the issue?
So wholly owned subsidiaries, though they are exempted from the limits to be reckoned with. However, if there is a composite limit taken for a loan or investment to be made, the investments made in the wholly owned
Yeah,
subsidiaries
yeah.
have also
See,
to be included.
the whatever the investments or loans which you are given to wholly owned subsidiaries, no doubt these limits are not applicable. But when you are working out the limits for other loans and investments and all, these are also to be added back to that. So it is not like that it is a complete exemption. Only that exemption for the wholly owned subsidiaries for the purpose of subsection 3 only, not in general. And so all the other 186 compliances are very much required. Even if you are lending money to a wholly owned subsidiary, limits may not be applicable. But other provisions of section 186 are applicable, like your interest and all other whatever the things, entry in the registers, blah, 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 all of that is applicable. Okay.
So suppose the limit of the company is 200 crores and they have already reached 190 crores and it is again extending 20 crores to its wholly owned subsidiary. It may not be required to take a special resolution immediately, but obviously they have to, since now its investment limit has reached 210 crores, it has to take a special
They
resolution and
cannot
increase it
lend or invest anything, even a single rupee thereafter.
thereafter.
Before before doing even a single rupee transaction thereafter, they have to have the special resolution in place. Correct.
Further, it also provides, the section also provides for disclosures in financial statements. So all the details of loans, investments, and guarantees, securities provided by the company needs to be disclosed in the financial statements together with the purpose for which the loan or guarantee has been made. The board and financial institutions. So all directors must approve the loan, guarantees, or investments. If a term loan is existing, then the public financial institutions approval is also required. However, the exception is if the total exposure is below the specified limit and there is no default. So if there is no default, then the approval of the financial institution will not be required before making such loan. The interest rate. The loans must
Have you crossed subsection 5, Alifia?
no, not yet.
Not yet. Okay.
No.
Fine, fine. There I have a few points to add. That's why I'm asking you whenever you come to 186.
Regarding public financial institutions, the subsection 5 consists of that only. So, regarding public financial institutions approval in case of default.
Okay.
So, the interest on the loans must be at the prevailing yield of government securities closest to the term of the loan, as we had already discussed. Companies in default on any deposits or interest cannot provide loans, guarantees, or securities until the default is resolved. Further, the companies need to maintain a register with the details of all such loans guarantees at the registered office of the company, and the same shall be made available for inspection.
I think you have come to just go to the previous
Yes.
slide, Alithia. Go to the previous slide.
So it was regarding subsection 5 pertains to the existing slide only that we were
Specific
deliberating.
approval, specific approval. Anyway, that what I'm trying to say here is under subsection 5 of section 186, there is a requirement that unless a resolution is passed at the board meeting
All direct.
with the unanimous consent of all the directors present at the meeting, you cannot make investment, lend money, or provide guarantees or securities. So that means what? Okay, like unlike 179, you cannot have an umbrella resolution, and you have to have specific resolution for making any kind of investment in any company or to lend money to any specific company. You have to have specific resolution. You cannot have an umbrella resolution. Say, for example, the board is authorizing to lend money up to say 25,000 crores. And in that 25,000 crores, you are covering, say, for example, 10, 15 companies and all, you are go on lending money. No, it will not, it is not correct. What you have to do is you have to have a specific resolution naming the every company. Now the question comes that how can I say, for example, sometimes whenever you are having a surplus company, in case of bigger companies especially, they do invest some kind of the temporary surplus funds in the bonds also, or maybe in the suppose in the secondary stock market. Some companies do invest their surplus funds in that. So whenever we are doing that, the Treasury Department may not be having a time to take that approvals and all before you are doing that. So how to take that challenge? So what one has to do is under 186, whenever you are taking a resolution, you can take an umbrella resolution. Say, for example, especially I'm talking about bigger size companies or cash rich companies. Depending upon how much tentatively you are going to invest, either in the bonds or in the equity in the stock market, what you can do is take the permission from the board, get a resolution, pass an umbrella resolution to make investments, to lend money, to provide guarantees or securities to body corporates or to companies, whatever you want to say, up to rupees X. And then you say that further the board is also authorizing to make investments or to lend money, blah, 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 in the following companies. Then you give that 1, 2, 3, 4, 5 like that, and then give sublimits of that. Within the overall limit, you can have sublimits. In such case, what you can do is you can certainly go and make investments without going back to the board time and again. Or alternately, if you don't want to give sublimits, you can say that the company can make investment, lend money, blah, 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 and all to the following companies, subject to a maximum limit of X. Then you specify the companies, that also is fine. Now the question after that, because please remember that the resolution, whatever you are passing, unlike 179, you cannot delegate it. The board cannot delegate the power. Board has to exercise the power of making investments, giving loans, providing guarantees and securities at the board meeting only. So that means you cannot even pass a circular resolution. Even at the board meeting also, whoever are the directors present at the meeting, say for example, it is a 10 directors board, out of that 8 people are attending the meeting. So all the 8 have to approve that resolution. Then only it is passed, otherwise it is not. 7 people have given approval, but one person has disapproved the transaction, that particular resolution, that means the resolution has fallen. You cannot do that. Unanimous consent of all the directors present at the meeting, not the entire board, but present at the meeting is required. So then the question comes that this specific resolution, when I am talking about, you can pass an umbrella resolution. After that, you can subdelegate that power. That means you can delegate that power to a finance committee or to your CFO or anybody else also, depending upon the size of your company. But as such, you cannot delegate the power unless until the board passes the resolution. You cannot delegate the power. Once you pass the resolution, yes, you can delegate the power. Yeah.
Sir, but you mentioned to provide the sublimits in the companies where the investment is to be made. If the approval is not taken, such only umbrella resolution is passed up to an X amount. So subsequently, if the company makes investment in a particular company, then it has to again go the board, or it can delegate power in that case also.
No. You cannot delegate the power. You have to name
Have
the
to.
company in the board resolution. If you are
Okay.
making an investment or if you are lending the money to any XYZ company, that company's name should be there in the resolution. What I was trying to say is, for example, you are taking an umbrella resolution up to invest of 1,000 crores.
Hmm.
In that 1,000 crores, all the 4 activities are combined.
About.
So the overall limit is 1,000 crores. In that 1,000 crores, it is up to the board. They may say that, okay, out of the 1,000 crores, 500 crores, up to 500 crores, you may give loans. To 500 crores, you
Fine.
may make investments. Or alternately, you may say that out of the 1,000 crores, up to 500 crores, you may lend money. Means what? Up to 1,000 crores, you can make investments. But as far as the lending is concerned, it is only 500 crores. So overall limit is 1,000 crores.
Okay.
Similarly, further, they can also say they don't want to take the exposure more. Even that 500 crores should not be delegated to one company only, they lend to only one company. So they can say overall limit of lending is 500 crores, but that particular thing you have to give the sublimits. So you can say the lending can be happen or the investment may happen to the following companies subject to a maximum of say 50 crores or 100 crores. So it depends entirely upon the board how much risk they are taking it. And because it is the, again, company secretary and the CFO, they have to sit together, draft the resolution properly, and explain to the board and then get it passed. Otherwise, what will happen is you will have, sometimes it may so happen, you may not be able to wait for the board approval. But this particular resolution is a prior resolution. You cannot pass it by circulation. You have to have the board
Have to
meeting
have a
only.
board.
Yeah. So proactive planning is very much required. That is what I'm suggesting actually. This is what exactly we used to do it in the past. Yes, Alifia,
So
go
the
ahead.
exemption, yes, subsection 11 also provides certain exemptions, whether loans, investments, or guarantee or security is provided by a banking company, an insurance company, housing finance companies, and companies involved in financing. Further, infrastructure activities are also exempted. Investment companies, rights issue, NBFCs are also exempt from these provisions.
I think let me just one more thing also come to my mind when we are talking about this subsection 7. You cannot give interest-free loans even to your wholly owned subsidiary also. And that interest rates are also given that no, the GSEC rates, it
For
cannot
the
be below
government.
the GSEC rate, right? Depending upon the tenure of the loans, 1, 3, 10 years like that.
Yes.
For example, that you have a subsidiary company which is incorporated abroad. Now, your suppose okay, as far as that Indian conditions are concerned, this average rate of interest is, say, for example, 8%. The GSEC rate for a 3-year term loan is, say, for example, 6%, not 8%, 6%, take it. So you cannot lend money before below 6%. Now, your subsidiary company, which is there abroad, There the interest rates are much lower than the Indian interest rates. But no bank is ready to lend money to your foreign subsidiary because it has no financial strength. Question is, can you lend the money to that subsidiary company below the GSEC rate? Answer is no. Whatever the circumstances may be, you cannot lend money below the GSEC rates. Question comes that can a parent company, that means holding company, can you give a guarantee to that company which is going to borrow the funds lower than the interest rates, the GSEC rate and all? Answer is yes. As far as guarantee and security is concerned, it has nothing to do with the interest rates. So if holding, as a holding company, you are providing a guarantee or a security to a foreign bank, which is lending money to your foreign subsidiary, you have nothing to do as far as the interest rates are concerned. Number two, whenever you are making an investment, say optionally convertible debentures or fully convertible debentures, the question comes whenever you are subscribing it, a debenture suppose, is it an investment or is it a loan? So in the erstwhile 372A, there was a provision that in case of any kind of subscription of debentures, it is a loan nature. It is in the nature of a loan. That is not there under 186. So now subscription of debentures, partially convertible, fully convertible, or not convertible, it comes under investment, it not come under lending the money. So you don't need to worry as far as that interest rate is concerned of that when you are subscribing the debentures of a company. Okay.
In fact, in 1956,
So
we used
if
to
I
talk.
may,
In 1956 Act, we always used to talk what you said, the GSEC rate. There used to be a concept called prime lending rate, PLR. Either it is equal to the PLR rate or over and above the PLR rate. That used to be the case. Yeah.
No, there they have specifically mentioned that if you are that subscription to the debentures is in the nature of a loan. That is not there now. So it is comes under 186 C bit. That is C talks about 186 to C, not to A. 2A is lending, 2B is guarantee securities, and 2C is investments.
Yeah, GSEC, correct.
Now
Government.
some people what they say also is that this OCDs and CCDs are debt as far as RBI is concerned. Till the time the conversion has not taken place, RBI under FEMA it treats as a debt. No doubt, it is a debt as far as FEMA is concerned, but it is not a debt as far as Companies Act is concerned. Okay.
Yes, I'm sure you wanted to add something.
yeah, just wanted to add to what Sudhakar said say about interest rates to foreign subsidiaries. So no, many times what happens is like I have experienced it myself. Initially, so you have entered into the loan agreement because of no transfer pricing regulations. You have taken some benchmark of the interest rate and you have entered into some X percentage loan agreement, say 6% for 2 years. If, thereafter, you are increasing the tenure of the loan, say from 2 years to 5 years. Don't forget to do the benchmarking again. Don't extend the loan period from 2 years to 5 years without doing the benchmarking again. Otherwise, you will again violate the provisions of the act. You have to do the benchmarking at the time of increasing the tenure from 2 years to 5 years because interest rate may change. Point number one. Point number two, I think we should just discuss about 60% of paid up capital, free reserves, and etc. 100%. What is the no paid up capital, free reserve? As on what date should be taken into account? I think a lot of people have confusion in that point also. What is free reserve? As on free reserve, as on what date should be taken? Paid up capital and securities premium, as on what date should be taken? Say we are sitting on 5th of October today, and what if I'm making an investment? These three things, as on what date should be taken into account? So I'll just give my views and then panelists can add. So coming to paid up capital, in say supposing we are giving loan today, the paid up capital as on date, whatever is that should be taken into account. Same is the securities premium. But coming to free reserve, as we know, is a defined term under the Companies Act in its latest audited, which is available for distribution. So if your March, in example, March 24 is the audited financial, then you must take free reserve as per financials of March 24. If for any reason you have got your balance sheet audited thereafter, then you can take the free reserves thereafter. Otherwise, free reserves has to be compulsory taken as of last audited financials only. And so that was on my point. What is a free reserve? So in my view, then because of the definition of free reserve, some people say retained earnings should be taken as part of free reserve, only the general reserve should be taken as free reserve. So in my view, profit and loss, retained earnings credit balance can be taken along with the general reserve. Whether debenture redemption reserve, ESOP reserve, CRR, are these free reserve? Answer is no. They have been prepared, they have been made for a specific purpose. Until the time that purpose is not achieved, say DRR, the debentures are not fully redeemed and DRR is transferred back to retained earning, this till then they are not free reserve and they cannot be taken into account. Yes, I'll just take a pause and wait for your view.
And so what you said that surplus in the profit and loss account is general reserve or free reserve?
No, I said it can be taken as part of 186 as a free reserve.
Yeah, because you have mentioned as general reserve. That's why I'm
No, no. I said
sort of.
as part of free reserve, general reserve plus profit and loss account credit, that is retained earning, can be taken into account.
Yeah, I agree
Yeah.
with you, whatever you said, except that one point that you have mentioned in case you have audited the accounts in between the year for any purpose, you may take those reserves as free reserves, but my view is better not to take that because
Okay.
the audited financial statements has its own what's called as how can you call as audited financial statements? By merely a chartered accountant is verifying and preparing your financial statements, you cannot say it is an audited financial statement unless until the audit report is given. So in between the financial year, if you are getting the accounts audited for any purpose, that is only as a requirement of a banker or a funding institution or whatever it may be, that auditor might not be giving a Caro report definitely. For a moment, even if I take it, he is giving a Caro report, but still those accounts are not adopted by the shareholders. So there is another view also, unless until the accounts are adopted by the shareholders, you cannot call them as audited financial statements. So my view is, no doubt about it, as far as the paid up capital is concerned, take the paid up capital as on the date. As far as the other things are concerned, your security premium also you can take it, not an issue. But as far as the reserves are concerned, you have to depend upon the latest audited financial statements available with the company. Yes.
Okay.
So moving forward, subsection 13 provides for the penalties which are imposed whenever there is a violation of section 186. So fines for violation range from rupees 25,000 to rupees 5 lakh for the companies, and for officers in default, they may face imprisonment up to 2 years and fine from 25,000 to rupees 1 lakh. So the word
So
end is very
this is
important to
why
work
I
on.
said that this is not a compoundable offense
Compoundable offense. Yes.
because it is
And
imprisonment and the fine. I'm sure
so
all the
those,
participants know that what is a compounding and what is a non-compoundable offense. In this case, imprisonment and fine is there, so it is not a compoundable offense. As I told you that, let me reiterate, under the old 372A, there was a carve out that before the ROC initiate the prosecution proceedings, if the whatever the money you have lent, if it has come back, then there won't be any kind of imprisonment. There will be only the fine will be there. Why I'm saying this thing is that in one of the companies where I was working around that time, it was a cash rich company. And it has violated that section 372A before I joined that company. When I joined that, I noticed that particular non-compliance and I brought it to the notice of my what's called a chairman at that point of time. And he asked me that what is the thing there. Then I said it is a non-compoundable offense. But if before ROC initiate a prosecution, if the money comes back, then there is no issue. So obviously, what I used to do at that time was I used to keep a track with the ROC's office whether they are initiating any prosecution proceedings. Had that been the case, my chairman assured me the money will come back. Don't worry about it. So which I used to do that. This is how one has to do sometimes. Okay.
Further, there is an extension of Section 186, which provides that the loans made to wholly owned subsidiaries and joint ventures are exempted under Section 186 3. And further, any investment, acquisition of shares in the wholly owned subsidiaries is also exempted. However, the details must be disclosed clearly in the financial statements of the loans made or investments done in the subsidiary. Further, loans and guarantees for repayment are part of the financing activities or NBFC, and they have to follow as per the RBI guidelines. Further, the companies registered with SEBI have to follow the respective SEBI regulations on intercorporate loans and deposits as per Section 12. The companies are required to maintain a register for all the loan, guarantee, security, and acquisitions have made since incorporation. Further, the record of all the transactions have to be made within 7 days. The register shall be kept at the register office permanently under the custody of the company secretary or an authorized person, and the entries made in the register must be authenticated by the CS or the authorized person. The register can be manual or electronic. Again, this is the maintenance of register is an important compliance which the companies have to do where all the loans and guarantees are recorded. Rule 13 provides for special resolution passed at the general meeting must specify the total amount up to which a board is authorized to give loans, guarantees, make acquisitions under Section 186(2). So it cannot be a blanket approval. There has to be a specific limit specified in the resolution up to which the approval is being sought from the shareholders. The company must also disclose full particulars of such transactions to members in the financial statements as required under subsection 4.
So before you go, Alifia, you go to 187, I just want to add a couple of points on 186. Just go back to the earlier slide. Yeah. So regarding disclosure in financial statements, I would just want to emphasize here that most of the companies that I have seen miss on this part of disclosure in financial statements. I'm going to say, I don't know whether we are not aware or whether we don't have any voice to say to accounts department that this is must and it is required to disclose in the financial statement. Whatever is the loan guarantee and security given by the company during the particular financial year investment, it has to be disclosed in the financial statement along with the intended use by the recipient. In fact, on top of it, at the end of the every financial year, you must take a certificate from the recipient company that I had taken this loan from you and I have utilized towards the intended purpose that I had initially disclosed. You must take a confirmation on this. Adding to it, secondly, you know, in India's scenario, the supposing you have made investments into the NCDs of various companies or bonds, etc. Generally, it would be valued, disclosed in the financial as per Ind AS as a fair value and not the original cost. So, just a point of caution here: when you are calculating about how much to invest further and etc., whether you're within the limit and etc., please don't go by fair value as is disclosed in the financial statement. You have to go back to your accounts department and ask for the original cost of these investments and then calculate. Then don't go by the what is disclosed in the financials. Firstly, it would be as on March, and you need the investments as on date today. And secondly, you need the original cost and not go by balance sheet. It might be generally NCDs and etc. in India's scenario are disclosed on the fair value method. Secondly, also while disclosing in the financial statement as per 186.4, please disclose the amount of investment which you have made and not the fair value amount. You may want to disclose both, but the original cost is required to be disclosed in my view. Yeah. Anything we want to add, sir?
Yeah, this is okay. That only thing is, Alifia has mentioned that about subsection 11, where the exemptions are there from the 186. So though those transactions are exempted as such, but please remember under subsection 3, whenever you are working out the limits, those investments or lending or whatever it is, which is exempted, those are to be added back, except only in case of a rights issue. Whatever the amount you have made investment in the rights issue, you don't need to add it. But all the rest of the things, you have to add it. Number two is that a question has come up. Suppose I have given the loans and that loan we are not able to recover, and we have made a provision for the bad and doubtful debts. Now, the question comes that in one of the companies, the CFO is asking that since we have made a provision for the bad and doubtful debt, let us not take this in the subsection 3 limits. So I have been asked whether can we do that. The answer to that is no, you have to still take that in the limits unless until it is out of your books, that whatever the loans you have given, if you write it off in the books of accounts, then yes, if that your limits and all, you can remove that particular loan amount. Merely making a provision for the bad and doubtful debts, that doesn't mean that may still you have a right to recover that money. So it has to be within that limits only. And then comes performance guarantee. Another question is, suppose if I am giving a performance guarantee, is it covered under 186? 186 clearly says that if you are provided any guarantee or security in connection with a loan, then only 186 gets triggered, otherwise it is not. So that means if a company is giving a performance guarantee, most of the times it happens that whenever you are making imports, exports, and all for the customer's purpose, or sometimes for the purpose of your GST, the earlier we used to have that excise and service tax and all. Sometimes the parent company has to give some kind of performance, suppose some kind of guarantees. If that guarantee is not a financial guarantee, that means against a loan, then you don't need to worry. 196 doesn't get triggered. Similarly, your subsidiary company is taking up an operational contract and the other party is asking for a parent company performance guarantee. Then also 186 is not going to be applicable. And if I'm not wrong, I think 186.11 exemptions. There is also one exemption if a company has incorporated with the object of financing industrial enterprises, then that is exempted from the provisions of 186, except that subsection 1. Please remember that several company secretaries used to make a mistake. They think that by merely having this particular objects in the main objects clause, you can avail that exemption. Answer is no. Under the 372A, it was not there clearly. It says that if it is having in the main objects clause, you can do that, and several people used to take the advantage of that. But even that time, the ROC was taking a view that merely having that object is not sufficient. You have to be in the business of financing the industrial enterprises. Whereas now it is clearly provided that companies established with the object and engaged in the business of financing industrial enterprises. So that is the difference between 372A and 186. 186, it clearly said that not only having the object in the objects clause, but you have to engage in that particular business of financing the industrial enterprises. Then only you can avail the exemption, otherwise not. So please take a note of this also. Yeah.
I could see some questions in the chat box on person. What is a person? So, just want to address a few points on this point.
I
So,
think
as we
I'm sure that Professor Bala will take care of, I think, right from the beginning, one by one, all these queries, and then you can answer
okay,
that.
understood. Fine, sir.
Yeah.
I think we can finish up this presentation, then we can take up the questions. Yeah. Yeah, please, Afliya, go ahead.
Yeah. So we move on to section 187, which provides that the investments made by a company in any property, securities, or assets must always be held in its own name. However, there are certain exceptions provided wherever a company may hold shares in its subsidiary in the name of the nominee shareholder. This requirement because of the statutory minimum number of members to be two. And the company can deposit shares or securities with their bankers, State Bank of India or scheduled bank, for the purpose of collecting the dividends or interest to facilitate the transfer of shares or securities. And wherever there is no transfer occurring within 6 months, then the company must get those shares retransferred to itself from the bank. Shares or securities can also be deposited with any person or security for the purpose of repayment of loan or to meet any other obligation as a part of condition of loan. A company can hold investments in the name of the depository if the securities are held by the company as a beneficial owner. Further, a register of investments not held in the company's own name under Clause D should be maintained with the proper particulars. The register must be opened for inspection by any member, debenture holder without charge or subject to reasonable restriction. The penalties for compliance of non-compliance of Section 187R, the company is liable to a penalty of rupees 5 lakhs and the officers in default are liable to a penalty of rupees 50,000. So we are done with you.
Okay, then I think we can proceed with the questions. Let me start from the very beginning. Holding company to subsidiary company that we talked about it. As per section 196(11), infrastructure companies are exempt. A company is having turnover of 98% from non-infrastructure business and only 2%, 0.02% from infrastructure business. Can the company still claim exemption under section 186(11)?
Actually, you are going to answer it? Should I answer it?
I'll just give my view. So since the money is fungible, how, if you want to take exemption, how would you say that this money which I'm using towards infrastructure activities taking exemption has come from infrastructure business? Unless and until you are very clearly maintaining that 100% demarcation, then otherwise I don't think you can take this exemption. Yes, sir. Over to you.
No. The question also is this. If your company is an infrastructure company, then it is exempted from 186(11). Okay. So his question is, suppose the income of his company is 98% income is from the infrastructure business.
No,
And 2%
non-infrastructure
is
business. No, 98% non-infrastructure business.
Oh, sorry. 98% non-infrastructure business and 2% is from the infrastructure business. Can he take it? The answer is clear no. That means your company is merely having an object of some kind of providing infrastructural facilities, but you are not engaged in the business. So your company, you cannot call it as a company under the infrastructure activities are given under Schedule 6. So unless until you are into the business, you cannot get that exemption.
Absolutely, you're right, Sudhakar. I agree with you. That's a correct point, I think. Interpretation is very correct. Because when you are doing a 98% of the business non-infrastructure, how can you call it infrastructure? Okay. Can a subsidiary company give the loan to the holding company? I think we discussed that.
Yeah.
If any guarantee or security provided to MD or WTD, then the exemption can await. That also I think you discussed in connection with the loan.
Yeah, we discussed this, sir.
Yeah. Does a company investment in mutual funds attract section 186?
See, this issue has come. Anshu, you will answer or should I answer
Please, sir,
it?
you take it.
Yeah. So this mutual funds is a perennial issue. This was there under 370 also, 372A also. Sorry, as well 372, then 372A, now it is 186. So mutual funds basically they are trusts. And trust is not a body corporate. So because of that per se, the mutual funds are not falling under section 186. But however, whenever you want to make any kind of investments in the mutual funds, you have to have the board resolution under 179. 179, you can take an umbrella resolution, and then mutual funds, you can get it covered there. But only one company which was having mutual funds, that is UTI, that is actually the mutual funds of UTI earlier. I don't know now what is the position. Earlier, it was not under a trust, but it was a company. So if you are making an investment in the UTI mutual funds because it is a company, then 186 gets triggered. S12 372A, it was getting triggered at that point of time. That is the answer to this. So to just summarize, mutual funds investment as such, 186 is not applicable, 179 is only applicable.
So I just want to add here, absolutely agree with you what you guys said. So for 186, 186 to apply doing investment, the two conditions have to be met. Firstly, it has to be the investment in the securities covered in the definition of securities under the SCRA, and it has to be investment in the body corporate. If both these conditions are met, that is investment in the securities of an entity which is a body corporate, then only it will apply. Yeah.
Sudhakar, as you rightly said, UTA still continue to be a company actually, but only thing is, if I not mistaken, it has got the multiple matches, and the mutual fund is actually one of the branch what UTA is doing. Can a subsidy of 100% or otherwise can give loan to its holding company if it is out of their profits?
Oh,
Sorry, sir, I think we discussed.
Yeah,
she has clarified this already.
Yeah,
loan can be given to a
discussed
manager.
that.
The loan can be given to a manager. We discussed actually.
Yeah, you proceed.
Can a private company receive loans from director and their relatives and pay interest of 12% per annum should the company pass any board resolution in this matter? Can a private company receive loan from director and other relatives and pay interest of 12% per annum should the company pass any board resolution in that matter?
So I think this will be covered under deposit rules, right? If it is exempted under deposit
185,
rules,
186
then
doesn't get triggered, but it gets covered under the deposit rules. In the deposit rules, if you are receiving any private companies are receiving money from the directors, it is per se exempted, but there is subject to some rules are there that one need to just check into that.
Yeah. Just again on the same topic, clarifying that 185 and 186 all about giving of loan, guarantee, security, making investment. It has nothing to do when the company is receiving the loan.
Can a wholly owned subsidiary provide loan to the holding company? In such a cases, if section 185(2) is not triggered, we should comply with the section 186 as we are right.
So we have taken this up and we have clarified that one subsidiary can give loan subject to compliance of 185 and 186 has to be complied.
Okay. There is an article sharing. Okay. What about the giving loan to LLB where company is a partner?
Why can't you say that? Where can we find the articles of Balakrishna?
That I already replied. That is why I have not taken.
Okay.
That I already given a clarification here. There is an article sharing group is there. If anybody wants to receive that, and you can actually either get in the WhatsApp message one of these number which I can provide. I can say that I have given. That is why I have not taken that.
Great. Okay.
Yeah. I already given the information there.
Oh.
Whether loan can be given to the private limited company to the other partner of the firm in which the director is one of the partners.
See, again, I always say that this kind of one-off questions, are specific questions. Instead of asking this, please, because what happens is several times I have mentioned about this, unless until you give the proper facts and we examine that, we cannot say yes or no answer. Legal provisions we have already discussed under 185 as well as 186. Please examine that based on the discussions, whatever we had, and based on the refer sections, together with this presentation, And then still if you have anything, then you can approach it. But let us not answer this kind of questions, sir. Because it may be interpreted in a wrong way.
If we passing a resolution under section 185 without specifying the party, blanket approval to provide loans to the guarantee where the directors are interested. I think we discussed about the blanket approval. You actually explained it very well, actually.
So that is in case of 186, you cannot give blanket approval and all.
Yeah.
And here also, what happens is that in case of 185, where the directors are interested and you are passing a special resolution, but when you are passing a special resolution, also there you have to give the details. You cannot have a blanket resolution.
Correct.
You have to say that to whom, which party, where the director is interested, to whom it is giving and all, and you have to mention again the full details in the explanatory statement. So under 185, according to me, no blanket resolutions are possible.
Yeah, in fact, you also have to give the intended use by the recipient.
Correct.
Notification dated 5th June 2050 giving certain exemptions to the private limited company, including section 185, still applicable. I think you touched upon this actually when you are talking about it.
That circular is still the circular is still in place, and you can get that exemptions provided you are eligible for that.
Intercompany account payable, if it is exceed 90 days, will it become a loan to subsidiary?
See, I think I presume that he's asking about the book debt.
Yeah.
Okay. If that book debt, the credit period, what you are giving to all the parties is 90 days, then it is fine. But if you are giving an exorbitant credit limit to anybody, then it will come definitely as a loan. Say, for example, you are giving a 30 days credit period, and to your director, you want to give a 90 days credit, it is a loan. Because you are doing it by way of a book debt.
I have one small question, Sudhakar, on this. Suppose you are giving a credit period, say 90 days, whatever you have said. But there is a condition there. After the 90 days, if the payment is actually delayed, it is actually chargeable interest so much.
No, that is different. But why that 90 days? Others you are giving 30 days. To the director, you are giving 60 days extra. That itself is no, that means what? It is not a book debt.
No. I am giving 90 days only to everybody. But I am saying for everybody, even if it is beyond 90 days, that the interest rate is actually chargeable to that up to this period.
If you treat the director the way you are treating other,
yeah,
then there is no issue.
Okay.
Yeah.
Whether exemption to the private company is still in place to satisfy these conditions, that as earlier there was an exemption and now section 185 is fully replaced. Please give your comments.
I have already given that. The circular is valid.
Yeah.
There are practices in the private company that keeps lending and receiving money from these related group companies as per their business need and without any written agreement. Can a company pass a single special resolution setting out the blanket approval upper limit that as and when the required company may lend the loan 1 or 2 branches of the related companies in business purposes? I think blanket approval is not permitted. That you discuss elaborately.
I have mentioned that how the resolution is to be taken, I think. Very clearly I have mentioned it.
Why LLP is treated as a firm instead of the body corporate for the purpose of section 185?
Because otherwise the intent of the section would be defeated.
Can the company give the corporate credit card to facilitate directors? If the company gives such a credit card, then do we need to comply with section 185?
See, this also I have mentioned very clearly. You can give a corporate credit card to your directors for the official purpose. I also mentioned that by any chance, if that director is using that card for any private purpose, for a personal purpose, before that payment becomes due by the company, if he pay that money to the company, whatever his personal expenditure is there, it will not be treated as a loan.
Section 186, subsection 1 says a company cannot invest in more than 2 layers of the investment company. Can a company invest in more than 2 layers of the non-investment company?
Technically, yes.
Is the 2-layer restrictions applicable to foreign investment subsidiary or Indian company?
See, there are two things here. One is that lending money through investment companies. Second thing is having the layers of investment investment companies. So now you cannot have more than two layers of the companies also. Forget about investment companies. I think that is somewhere in 2016, 2017, it has come that on that particular day, whatever the subsidiaries, the chain of subsidiaries you are having, you can continue that. And suppose if any company is going out of the chain, suppose six subsidiaries, A, B, C, D, E, F, and out of that C is going out, you cannot say, okay, I will get it back. No. As far as the 186 talks about lending money through investment companies, there is a difference between the two.
If company entering into partnership, then compliance of section 186 is required or not?
Should I?
Yeah.
Okay. So it depends. If you're giving loan to partnership, I mean to say the nature of the transaction is not clear. If your company is giving loan to the partnership, it will be any person, and yes, 186 will be applicable. If you're making a partnership, you're making your contribution towards the partnership as a partner, and then it will not be an investment, but so it will be applicable.
Is surplus
See, if you are,
balance? Yeah.
if you are joining as a partner, the corporate entity is a partner in a partnership form, and you are making an investment as far as your capital is concerned, you have to have 186 resolution.
Yeah.
Is surplus balance in the statement of the profit and loss account is considered the free reserve for the purpose of computation of the limit specified under section 186, or else the company required to pass some resolution to create free reserve out of the surplus balance statement of profit and loss account. I think this you covered actually. Can we please take a practical illustration, say Byju's, that transferred more than 900 crores to the entity outside India?
Yeah, I don't know how Byju's have transferred 900 crores in what shape, and also we cannot comment about that.
If a company has got 3 directors and one of the directors is absent in the board meeting, then can the 2 present directors agree and pass a board resolution for making investment beyond the specified limit?
Yes, sir, of course. See, beyond the specified limit means what? They can pass a resolution with a unanimous consent to make investments or lend money and all to a specific company. But how can they go beyond specified limits?
Yeah, beyond specified limits, they'll have to go to the shareholder. That is one. Number
Yes.
2, you said actually unanimous approval for the people who are present in the board meeting.
Correct.
I think that answers the question. A company passed the board resolution to take a loan from a director. The said loan, along with the loan already borrowed, exceed the paid up capital of the free reserves. In this case, can the special resolution be passed thereafter? I don't know. We are giving about the giving loan to the director. Here you are talking taking the loan from a director.
Exactly, sir. Exactly. This is all about taking loan and not covered part of this topic.
This is not covered actually. Sudhakar sir, approval of the public financial institution required in the case of the where aggregate investment loan guarantee securities exceeding the limit under section 186. However, no default.
See, when there is no default, you don't need any FI approval. Exceeding the limits and all, that is under the Companies Act. As far as the FI is concerned, only when there is a default, you will go to them. Otherwise, you don't need to.
Is section 186 is applicable to NPFC base layer, that is NSI, NDIA, etc.
Sir, so NSI, NDI means a non-systemic, etc. I think because
that is right.
Non-systematic.
Correct.
So if it is a NBFC, loan and investment FCFC, if the NBFC is a loan NBFC and it is engaged into lending activities, that would get exemption. And similarly, NBFCs which are into investment will get exemption from investment activities, irrespective of they are NDI or non-NDI, non-systematic or systemic.
Will loan to listed subsidiary be covered under section 185 even if the directors of the holding company does not have any shareholding in the subsidiary company?
Loan to listed. So as far as 185 is concerned, there is no distinction of whether it is subsidiary or no subsidiary. Whatever the principles that we have discussed so far will apply.
Is section 185 applicable to the NPSC base layer, NSC? The same question is repeated. Does corporate guarantee given by the company include a director's personal liability, or it would completely depend upon the arrangement and the language of the MOU between the company and the financial company?
The corporate guarantee has nothing to do with the personal liability of the directors. Corporate guarantee, when you are giving, means only the company is liable to do that, whatever the conditions are there. If the promoter or any director give a personal guarantee, of course, to that extent, they will be held liable.
Capital reserve can be taken as a free reserve for calculation.
How can it be? Free reserves definition is there in the Companies Act.
What is the definition of the person mentioned in the 186(2)? I think Anshul wants to discuss that time only. Yeah. Person.
Yeah, so person is not defined under the Companies Act, so it will include anybody, and we have to refer to the General Clauses Act definition of the person.
Is
But
it
an,
under,
Only
an
the employees
individual,
of the
this yes,
only the employees of the company are exempted from the definition of person.
yes, yeah, there's an MCA circular to this effect, also added in the explanation. So otherwise, person someone has also asked, even the individual will also be covered as a person.
Let me also take this opportunity to clarify one more thing. Several times the question comes, say, for example, if an employee is there and you have lent money to him, subsequently he has resigned, whether the loan is to be taken back. Similarly, when a company was a wholly owned subsidiary, it was exempted. Subsequently, during the tenure of the loan, that it ceased to be a wholly owned subsidiary, whether we have to take back that money. For all these things, please remember the provisions of the section are applicable at the time of giving the loan. If at the time it is exempted, then that whatever the tenure is there, it can continue, but you cannot renew that loans. But you can continue to that. But you cannot say, for example, if an employee is there, if your service conditions at the time of his resignation, he has to refund that money, that loan money and all, then it is a different thing. But suppose it says that even after the resignation of an employee, he can continue to avail that loan and all. Suppose if it is there like that, then there is no problem.
I agree with
But
Mr.
it is
Agarwal.
rarely it will
Yeah,
be
at
there
that
like that.
time.
It will never be like that.
Yeah, at that time. Yeah. Is it advisable to pass the board resolution every year in the start of the financial year regarding section 185, 168 within limit, or it is not required?
It all depends upon your company's requirements. And I told you 185 is not a blanket resolution. 186 maybe. Okay.
Section 185 exemption granted to the private company by the notification dated. I think this you already answered that question. Can the director provide a loan in the form of the goods like a company engage in steel business and director gives steel company? Can a director provide a loan means it is again taking a loan. So we are not on the topic today. Company keeps on depositing the surplus liquidity in a FDR, mutual fund, etc. and encash it as and when it is required.
See, only Bala, that before you take a further question, whenever you are taking the money from anybody, though the sections 185 and 186 are not getting triggered, but deposit rules, and it may fall under the deposit as per the deposit rules are concerned. So please be careful, because that is also an equally important section, and a lot of scope is there for interpretation, and any kind of non-compliance there is also going to catch your neck. Yeah.
Company keeps on deploying the surplus liquidity of the FDR and mutual funds, etc. They encourage them as and when it is required. Even the bank offers flexi deposit scheme where a part of the surplus money is also automatically transferred into FDR. Will such deposit be covered under section 186 and require entities to register investments?
She will take it.
Yes, sir. So mutual funds, etc., as we have already discussed, is out of the purview because it is not investment generally into the securities of body corporate. Coming to fixed deposit also will not come, in my view, as a because it is not covered under 186.
No, sorry. Fixed deposits were not covered under S12 372A. but fixed deposits are now covered under 186. So you have to have a resolution in advance prior that it is happening. That if the bank is transferring automatically some money to the FDRs, you have to have a resolution in place. If you are anticipating that, please ensure that you have a sufficient resolution for that. FDs are covered under 186.
Can a private company give non-interest loan to the directors and director relative? I think he discussed this actually. Then what about the investment, the fixed deposit by the company? That you talked just now only. Does section 179(3)(f) of the Companies Act concerning the authority to grant loan, provide guarantee or offer security in respect of loans apply to the non-banking financial companies NBFC? Furthermore, is it mandatory for the NBFC to obtain board authorization prior to granting any loan in the ordinary course of the business, or would the power be conferred to the company's article of association suffice on this record?
See, will you take this, Ashu, or should I take it?
So I've not understood actually the question well.
See,
Should I
it
read
is
out again?
whatever I understood, it is like this, section 179(3), 179 actually, you can delegate that powers. So board has to decide umbrella limit and you can delegate the power to a finance committee or to any individuals also. That is the answer to this question. 186, you cannot delegate it. 179, you can delegate it.
Can a company give a guarantee in which is not a private company? That is section 185 is not applicable.
So I think the question is, the recipient company is not a private company.
Yeah,
can a company
that
give
is
guarantee, which is
that is what it
can a
appears
company
to be.
give guarantee, which is not a private company? So if you're the lending company in the company which is giving a guarantee, if is a private company or public company, I don't think it matters. Basically, if you're giving a guarantee, it depends to whom you are giving. That question is, it is not clear. If it is to director, we cannot be given. We discuss even MD and WTD, it is not okay. If it is on behalf of a person in which the director is basically 185(2) category, then you have to comply with 185(2). So the question is not very clear here.
Is section
Only
186
thing what you can say is if that company to whom you are giving a guarantee, if it is falling under the definition of where the director is interested, ensure that special resolution is in place, then go ahead.
Yeah.
Okay.
Is section 186 also apply to the loan to individual director?
Sorry, what was
Yes,
the
if
question,
the
sir?
director is not an employee, he is not exempted. He covers under person. If he is an executive director, he is an employee. Like your managing director, your whole-time director, they are employees of the company. But other directors who are non-executive directors or independent directors, they fall under that. Of course, number one, अव्वल तो आपको 185 में it is prohibited to give any loans to them. Okay, but since the question is about 186, is it applied to for a loan to individual director? Just to understand hypothetically only I told you, but under 185, that loan to an individual director is prohibited. Where is the question of applying of section applicable of 186?
Okay, why LLB is treated a firm instead of the body car? I think that you answered actually. Whether the sponsor support undertaking extended by promoter companies for the joint venture company to the JV company, banker will attract the provisions of the section 185 of the Companies Act 2013. Whether sponsor support undertaking.
See, again, the same thing here, Bala, that as I told you, these questions are not having the complete information. But again, the same thing to answer that question is if any director is a director or a member of that particular other company, it will be, if it is coming under if it is falling under the definition that where the director is interested, then have a special resolution, then accordingly go ahead. So this is a general question as such.
Okay. Can a partner withdraw its LLP contribution for its personal use once it is deposited into the bank account after incorporation? I
This has
think
nothing to do
this is
with
not the
this.
subject matter here.
Yeah, correct.
Sale of goods to the private company where common director is there on credit beyond the normal credit period limit, section 185. I think you discussed this actually.
Yeah.
Can you please explain the background for NEFRA's recent stand that the holding company auditors will be responsible for the supervision of the audit of the subsidiary companies, citing alleged extensive violation of section 196, 372A by a DHIFL, IIFL, etc., and consequent failure of the holding companies?
See, because this is actually round tripping within the group, that funds what the holding company is getting, whether from the banks or whatever it is, they were doing a kind of round tripping within the group without ensuring the financial strength of the companies which are borrowing. So that is the overall scenario I'm talking about. That's why NEFRA came into picture and holding the auditors responsible, because it is a responsibility of the auditor whenever the company is giving lending the money, whether the other part, I mean, the recipient company is having proper financial strength or not. This is also one of the responsibilities of the auditors. They ensure. That's
How do
why
we
they said, okay, yeah.
how do we interpret make an investment through not more than two layers of investment companies?
This we already discussed it.
Either restrictions only when the layer is a subsidiary or in all cases?
All cases means what? It is only when it is a subsidiary, then only the restriction is there. It is the section clearly says that it cannot invest in more than two layers of the subsidiaries.
Yeah. In section 187, subsection 7, does the term loan include guarantee or provide security in connection with the loan?
187.7.
That is what it's written here, 187.7. Does the term loan include guarantee or provide security in connection with the loan?
I think the section quoted wrongly. I think in 187, there is no subsection 7 as such. Section is quoted wrongly. Yeah.
Whether section 186 loan guarantee is one and the same thing.
Loan and guarantee are not the same thing. Loan is different, guarantee is different. In case of a loan, you are exchanging the money. In case of a guarantee, you are taking an obligation. In case of a loan, you have to charge interest. And in case of a
Yeah,
guarantee, you don't need to charge interest.
yeah. In case of the loan, as you rightly say, it is the exchange of the money. But in case of a guarantee, it all depends upon the event which is actually going to take place for guaranteeing certain things. Yeah. Can NPSC account aggregator avail exemption under section 186 to grant loans?
See, if it is an NBFC company aggregator, if it is falling under the exemptions of 186, please see that. Then you don't need to comply with 186 except subsection 1. Otherwise, you have to comply with.
Can company give the loan to the public company where the directors are not interested without passing special resolution?
Sir, if I may reply to this, so I think he had just changed his, corrected his question of the earlier question. So if a company wants to give loan to public company where the directors are not interested, assuming that three criteria is given, the three categories is not triggering here of 185(2), then there is no prohibition.
I think that is all the questions which are there in the chat box. I think, Aflia, you can close the presentations. And if anybody wants to write the questions or something, they can raise their hands. We can allow them to speak. We can take some questions, I think. Although we are already at 1:05, maybe 3 questions we may take. Yeah. But I don't see as of now any hands risen. There is one hand risen by Priyanka. Yes, Priyanka, you can unmute, you can talk.
Yeah, hi, sir.
Go ahead.
Yeah, I stuck with this question regarding 186 subsection 1. which is stating about the restriction of 2 layers. So my question here is that this restriction says that investment company you cannot have 2 layers. So is there any other restriction that company cannot have subsidiaries more than 2 layers?
No, subsidiary beyond 2 layers is allowed. See, they are two different things. Under the
Yeah,
subsidiary layering rules, you can have one layer of WS plus two subsidiaries, right? Right.
yeah.
So that is under 287. Here what it says, supposing in the same example, supposing H is the holding company, it has subsidiary A, B, and C, right? A is WS, so fine. And it has two subsidiaries which are not WS, B and C, or you are well within the layering rules. In the same example, let's assume H has A, B, and C. All this A, company B, and company C, which are in the vertical layer, right? Not horizontal. So like H has A has B, B has C.
Hmm.
So if this A, B, and C, all three are say investment companies, right? And what is investment companies? That explanation is given under 186 at the end of the section. Okay, I'll just explain the definition in a while. But supposing this A, B, and C, all three are investment companies, then this layer is not allowed because you are exceeding more than 2 layer of investment company, right? Although under layering rules, it was a perfect structure, but under 186.1, it is not a okay structure because in this layer, in this structure, you have more than 3 layer of investment company, right? So
Hmm.
that is not okay. So now coming to the definition of investment company, if the object of your main MOA has the object of investment into investment into shares, securities, etc. A, and there is a deeming provision also. Supposing your MOA does not have any investment object, but your investment into the shares, debentures, or other securities is more than 50% of your total asset, or even if your investments are not less than 50%, but your income from investment from such securities is more than 50% of your total income.
Hmm.
So any of these three conditions, just repeating, your MOA has the object of investment, even if your object clause does not have, but if your investment is more investment into shares or securities are more than 50%, or your income from such investments is more than 50%, you become an investment company. Just more clarifying, investment company is a dynamic phenomena. Your investment, this company ABC in our example may be an investment company in the year one, and the year two it may change. So you have to keep on examining year to year.
Hmm.
I hope I have clarified.
Yes, ma'am, it got clarified. So, if I'm not wrong, it is like that. The restriction is for only investment companies' investment. So, if I'm having A, B, C, D, E companies in a vertical layers, like A is holding 50% stake of B, B is holding 50% stake of C, and C is holding again 50% stake of D. So, is it possible?
No, so you have to examine from the top, right? In the example that I gave is H. H has A has B, B has C. And A,
Hmm.
B, A3 or all three investment companies, this layer is not okay. You have to cut down one investment company because it is more than 2 layer of investment
All
company.
are non-investment companies.
If all are non-investment company, assuming A, B, and C are non-investment company, then you have to come to the layering rules under subsidiary definition. That is, one layer has to be WS.
Oh, okay, 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 okay.
That means in simple term, if it is a non-investment money, that is one subsidiary, one WS, and plus two more layers. Yeah. Yes, another hand is risen here. I think Madhur Gandhi. Yeah, you can unmute, you can talk. Madhur?
Yes. So my question is like, in practice, how do companies ensure compliance with the monetary limits as specified under Section 186 of providing loan guarantee or securities, especially where like multiple transactions occur throughout the year in the company? So how do we in practice ensure that those limits are properly maintained?
So, Madhur, you have to like how, as we have explained in detail in the entire session, that what are the no, how do you have to monitor? So maybe just a repetition of the same, and how you monitor is you have to monitor through your Excel, or you make some like how you monitor is up to you. But in practice, like you have to keep on changing, keep on seeing this, the facts, right? Every time when you're making investments, so your company is making investment today, you have to compute the paid up capital, securities and free reserves as on date, right? Free reserve as we discussed as on March, and investments till date, and then see what you are making it today, add together is exceeding the limit, whether you have board resolution, whether you have shareholders resolution. I mean to say, you have to keep check on of all of this, right? You have to keep your working sheet ready. Sudhasakar, if you want to add in.
You have to have a proper MIS from your accounts department on monthly basis. And you have to see that what are the limits you have as far as the shareholders and board resolutions are concerned. Let me also take this opportunity to tell one more thing. While passing the resolution, there are two ways of passing the resolution. Some people, what they do is the company can make investments, give loans, provide guarantee securities to a limit of rupees so and so. And some people, what they do is they also pass the resolution. The company can give loans, make investments, guarantee securities outstanding at any point of time to rupees so and so. There is a difference between these two resolutions. The first resolution is 2 rupees so and so means what? Even if that loan, whatever you have given, even if it is coming back, still you cannot take that into account because you have mentioned that up to rupees 100 crores means you have given loans of 100 crores and it has come back, but still, since you have exhausted the limit. Second way of passing the resolution is the company can lend money up to a sum of rupees 100 crores outstanding at any point of time. Means whatever the loans which are coming back, they are getting that limit replenished. So please ensure that while passing the resolution, you have to pass that very carefully. Yeah.
I think that is all. There's no more hands are risen. I think we answered all the queries. I think we can definitely close the session.
Yeah.
Alifia,
Great presentation, Alifia.
Alifia,
sir.
very nice presentation, very lucidity. You brought out all the section along with the decided case laws, etc. It was very good. Nicely you prepared the presentation. That is one thing. I'm sure excellent deliberation from your side, giving the various practical examples, how you are dealing with it, etc. I greatly appreciate your support on this. Sudhagar, I will not take thanks separately to you. Every time you make your contribution, which is recognizable. Now you can see almost about 210 people are there, even at 150. That it shows what is the learning which is happening through this webinar. It's an excellent session. And really, really speaking, I have once again rehearsed whatever the things I have learned actually in the past years. It is a very good learning for me, and equally good for the other people also. I think with this we can close the session.
You may announce that next week we are not going to have the webinar because of Vijay Dashmi.
Okay.
The coming Saturday there is no webinar because of Vijay Dashmi.
Okay, I think with this we close the session. We will yet to meet in the next week. We will meet at another session. Thanks a lot to everybody.
Thank you.
Have a good weekend. Enjoy your festival. Thanks, Anshu.
Thank you, sir. Thank you. Great.